Richard, welcome. Good as always to see you. You say being bullish or bearish isn't like a light switch that one turns on or off. Rather, it's like a dimmer switch that slowly gets dimmer or brighter. Are you getting dimmer? And that's not a reflection on your intellectual prowess.
Yeah. Tyler, yes, we are getting marginally dimmer. I don't want to make it sound like we're under our desks in the fetal position. That certainly is not the case. We still have a great deal of risk in our portfolios, but we are toning down the risk. I mean, as you said, there aren't many certainties out there, but we do know that profits are going to decelerate, and we do know that the Fed is going to raise rates. And so with that backdrop, history says it's prudent to start reducing risk.
And so where do you go to do that, or how do you tactically reduce risk in the portfolio? What do you bulk up on? What do you move away from?
So, Tyler, we have been very heavily weighted in what's commonly called late cycle investments, things like energy, industrials, things like that. We are still very overweight those, but we have also been overweight consumer staples, and we've recently moved more into utilities. Those are the traditional kind of spare tires in a portfolio that when things really go wrong, they tend to outperform. So we've been reducing our weight in these late cycle sectors very marginally, and marginally increasing weight in things like staples and utilities.
So you mentioned the two things that, and I think you couldn't be more spot on here. You've got profits slowing. You've got the Fed raising rates and tightening in other ways. Does that mean necessarily that a recession is inevitable, or could the Fed engineer the so-called soft landing, as hard as it has proven to be historically?
Right. Well, Tyler, I'm very skeptical that the Fed can engineer a soft landing. And the reason why is that if we go back to the late 70s, early 80s, I think the lesson that Paul Volcker taught everybody was that the only way that the Fed can truly stymie inflation is by crushing the economy. And what I mean by that is that we know that all inflation is demand greater than supply, right? If demand is greater than supply, prices go up. You don't need a PhD to figure that one out. So if you can't control supply, which the Fed cannot do ever, what do you have to do? Well, if you want to slow the economy, you have to stymie demand. And I think that's what they're very hesitant to do right now. They are so far behind inflation. They have a lot of work to do before they're really in a contractionary phase where they're hurting demand.